Welcome back. The sell-off at least has stemmed for now. We're still down 112 points, so there hasn't been too much of a recovery. But at least the selling pressure has abated. That big fall came between 11 and 11.20, and since then the markets are stabilizing with a cut of about 100 points plus on the Nifty, with the sensex down about 450 points. Let's invite George Thomas, the fund manager at Quantum AMC, on the show. George, morning, and thanks so much for joining in. Can you tell us what you are doing at Quantum AMC? Are you buyers in the market at current levels? If yes, which are the sectors that you like, and what is the investment approach that you'll follow?
Sure. Thanks for having me in the show. So basically, we have a long-term value approach, and what we are seeing in the market right now is post-COVID, the economy was in a natural upcycle mode, but because of a spike in inflation and interest rates rising over the last few quarters, that the natural economic upcycle was kind of delayed. But now that we are kind of, most of the rate hikes are behind us, and even inflation has started showing signs of moderation from here on. So we are quite positive on the markets from a medium-term perspective in the current setting. And therefore, we are buyers in the current market. So the sectors where we are kind of positive is the consumer discretionary, especially the large two-wheeler OEMs. Then IT sector looks interesting after the recent correction. We have recently added a lot of the savings-related themes, which are the AMCs, insurance companies, and broking firms, where we feel that the valuations are kind of attractive.
Okay, so do you just want to elaborate on that, George? The sectors where you are currently finding valuations attractive. You mentioned IT in that list?
Yes, sure, yeah.
Okay, so what's the thesis here? Do you think that what we saw in the first quarter, that was an aberration maybe with one or two companies like Infosys? I mean, truth be told, mid-cap IT has actually had a very decent quarter. A lot of the mid-cap IT companies. So what's your thesis in this sector?
Yeah. So if you look at the IT companies, the Tier 1 names, post-COVID, we had very high growth rates, and we saw...
Okay, I think we... Yes, please go on, George. Yes, we can hear you.
Sure. So obviously, going forward, being the macro scenario being slightly on a muted side, we would obviously see the kind of revenue growth to kind of moderate in the current year. But most of the Tier 1 names have corrected close to 20% in the last year. The order books are kind of stable. And if I look at the kind of growth rates which are factored into the Tier 1 names, they're at a reasonable discount to what we saw in the last decade. So obviously, and most of these IT companies have decent levers in terms of improving the profitability in the current year. So all in all, we are seeing a reasonable order book, plus stocks have corrected over the last 1 year, which makes the valuation quite attractive. So even if we were to assume a slower growth in the current year and probably the next year, the current valuations are quite attractive. And in terms of the long-term structural story, it remains kind of robust. And we continue to believe, the Indian IT companies should see decent growth over the next 4 or 5 years.
Okay, so you're definitely finding opportunities in IT. The other space which almost everyone seems to like in the market right now is the financials, right? Is that something that you like as well? And if yes, then what do you pick within the financials? They've had pretty good earnings as well, if you look at it overall.
Yeah, so the financials, the large banks, they are in an upcycle, and our sense is, the cycle is pretty conducive even for the next 2-3 years. Primarily because we might see some bit of moderation in their net interest margins and things as the cost of borrowing cost of funds kind of go up marginally. But from a cycle perspective, credit growth will continue to be reasonably good. Plus, the credit costs are likely to be muted because the asset side of the NPAs are not, doesn't seems to be, the cycle is quite favorable. So in that sense, we continue to like financials, especially the large banks.
Oh, got it. George, any sectors or themes are a complete avoid for you right now?
So there is nothing as such. Of course, a lot of the staples name still appear expensive for us. So as and when we get valuation comfort there, we would kind of evaluate.
So consumer staples, you're underweight or it's an avoid?
It's underweight. It's underweight. It's not an avoid.
Any other underweights for you?
The other underweight positions are durables, where we are looking for at better levels to enter.
Okay.
Okay. Overall, what's the sense in terms of the movement in the market, George? We've seen a good amount of outperformance from the mid-cap universe as well in the month of April. Incrementally from here, you think mid-caps will be the space where more money will be made, or do you think it'll be large-cap dominated?
Yeah, so we are kind of, market cap agnostic. Our sense is, in this kind of an environment, large cap kind of offer reasonable valuation comfort. They're still trading at somewhere around their long-term historic average, plus with a recent earnings visibility. So our preference would be for large caps.
All right, got that. George, we're going to leave it on that note, but thank you for joining us and sharing your views with us in the market as well as some of these individual pockets. We'll get into a short break now, but there's lots more market action lined up for you, so stay with us.